This is the first of 3 lectures being recorded for the students in Economics 53, and these are mandatory lectures, about the subject of employment and unemployment. And if you look at our schedule, this fits right in where it's supposed to be. The picture here was recorded on, the video was recorded on Saturday, March the 21st, 2020, at the end of a very eventful week. And tomorrow will be the beginning of a more eventful week, and the headline news will be about employment and unemployment. So we are going to take a look at the history of the subject and the like, but we are going to talk about topical issues as they unfold right at the time this is being recorded. When we look at the traditional numbers that make up this kind of lecture, it's going to sound like I'm talking about an economy from the distant past, like 1987 or 2015, because the unemployment picture is changing incredibly right before our very eyes, starting this week, and we have some data from this week, but it's next week and the weeks that follow that will completely change the picture and make these slides sort of nostalgic about the times when things were normal prior to the episodes that set this off. Now, I'm not going to talk much about the background. You already know about the background if you're watching this. This is right at the beginning, well into the beginning now of the, if you're looking at this as an archive lecture, of the coronavirus pandemic. And so today was the day when the worldwide count went right up to 300,000. So it's having economic impact that's considerable, especially in the United States. And that's the context in which this is being delivered. Now, the 3 parts will be unemployment and unemployment in numbers. Plus here we start talking a little bit about the topical issues that are likely to come up this week. And then we are going to go to the more traditional part of the slide set and not have much or any topical component, where we disaggregate unemployment, take it apart, and see who is unemployed on the basis of gender, on the basis of race, and the like. And when we complete that, we come back to the 3rd lecture and talk basically about 2 things: earnings and income and wealth distribution, because that's where they normally fit. This is where they normally fit. And asking the question, is there any reason for all of this complaining about the maldistribution of wealth and income? The answer to that's going to be yes. There is some evidence that the system is a little bit unfair right now, if not substantially unfair right now. And what's about to come may actually compound that difference more. There is possibly going to be a 4th lecture about the Phillips curve, but that was actually recorded last year, and I don't think I have to re-record that, so I may attach it as a mandatory in Econ 53, or I may not. So let's get into this. I think we usually begin this lecture by showing you some key employment and unemployment stats, and these are values for February 2020, the last month of the normal period. And so this was what it was like just before the pandemic hit. So, for example, the unemployment rate in February 2020, this data was captured in March 2020, the unemployment rate was 3.5%, and the year ago, which is represented in green, was 3.8%, so it's down a little from that. And the unemployment rate until this week has been really low, almost at historically low levels. And we'll talk about why that's true later in the 3rd lecture. The civilian labor force participation rate, which is the rate of people in the population who could contribute to the workforce, is at 63.4%. A year ago it was 63.1%. It has been slowly trending down over the last decade or so, although last year that pattern broke and the labor force participation rate started to increase, because just before the current problem, this economy was getting pretty hot for a period of time. There was a really good job market. There's a very important report that is put out once a month called the Payroll report, and we will look at the historical numbers for the Payroll report in today's lecture. But Again, the last figure that we're looking at here, plus 273,000, which is pretty good actually, and has been kind of typical, as we're going to see, again, is a bit misleading because, again, payrolls are collapsing at the time I'm recording this. I should say, for historical reference, the stock market has at times been very sensitive to this statistical release. And so that's not likely to change in this current environment. The average work week for all people stood at 34.4 hours, the same as it was in the year before. The average hourly earnings, which we'll look at, I don't think in this lecture, but a later lecture in this set, from a private non-farm earnings, has been gradually rising for about the last 2 years. A year ago, it was $27.69 per hour on average, and now it's $28.52. And so that was looking healthy as well. We've talked already about the employment cost index. It was up 0.7% for the fourth quarter of 2019, the same as it was the year before. This is a quarterly release rather than a monthly release. And again, remember, we looked upon it as a rational expectations leading inflation indicator. And finally, we've talked a lot about productivity already. Productivity does appear to be slowing down in this economy, or was slowing down before this current month. Was at 1.2%, which is well below what it has been in the past. We saw that number already. And it was 1.8% in a year ago. So remember the importance of the productivity number in the aggregate supply, aggregate demand model, because in the traditional economy, that keeps inflation at bay if that's a high number. So in summary, when we look at all of this, we see an economy that currently looked very healthy when this data was collected literally 1 week ago. Unemployment rate very low, average work week respectable at 35 hours, the employment cost index increasing a little but not at an alarming pace. Productivity was positive, could be higher and the like, but this was a picture of a stable, normal, healthy, albeit somewhat slow growth economy. Let's take a little bit more let's take a larger look at some of the indicators of how this has changed over time. So this is our first time series graph. And the first two are kind of tedious because look, it's just a straight line that goes up. It's growing at a continuous log growth rate of a little under 1% per year, at 0.877% per year. For this economy, that's enough to keep the unemployment rate actually down, considering especially that the labor force is slightly shrinking because of the aging of America. You can also see that this was steadily reliable, except for the 2008-2010 mortgage market crash. This did sort of dip down and then stabilize for a period of about 4 years before it resumed. And we did not see that in the 2000 to 2003 crash. There was a little bubble in 1999 because of the wild prosperity of 1999 that came back down. But aside from that, these numbers exhibit a steady growth. It's interesting to ask the question right now about full-time versus part-time. And I hadn't looked at this data in a few years, and I was surprised to see that the ratio is still as high as it is. The top line, the green line, represents full-time employment as measured by the Department of Labor Statistics, and the bottom line represents part-time employment going clear back to 1995. And you can see the axis is kind of squashed for the part-time employment, but if you take a look at the beginning and the end, you can see it has been growing, and the axis is more suitable for the top measure up there, the full-time employment. But you can see the ratio has been around 4.3 to 1, although it started at 4.3 to 1, and at the end, for the last piece of data, February 2020, it was 4.73 to 1. I thought this ratio was actually higher. I thought it was more like 0.35 or so. 35 million, not 0.35 or so. So I thought this ratio was going to be about below 4 to 1. I thought it was going to be in the high 3 dot something. So this is not quite the part-time economy I thought it was, based upon stuff I've read in the newspapers. But you can see there's a mix here. Now, let's start moving into the topical material. This is initial claims for unemployment. That, of course, is the leading indicator in this data. And this graph is from the Federal Reserve Bank of St. Louis, their FRED database. And so it shows the very long history of the 4-week moving average of initial claims. So, of course, this is a 4-week moving average. It would not be quite as sharp as it's going to be this next, I guess it's Thursday, that the new jobless claims will come out, but it'll still spike up. So as you can see now, this is where we ask ourselves, how bad can this get in a recession? So we need to dwell on this a little bit. And I like to use the FRED graphs because they always have the business cycles. In the graph is the gray area. So you can look back to the devastating period in 2009, and you can see that unemployment claims in 2009 at the peak exceeded 600,000. Now remember, that's a weekly number. It's not the number of people unemployed. It's the number of people who are filing for unemployment during that week. And so, of course, the number of unemployed is far in excess of this number. But this kind of shows you where the unemployment is going to go. So first of all, we see it peaking at above 600,000, but we see it coming back down, on the other hand, pretty rapidly after that period. Then the 2 recessions before, not very serious. We have to go clear back to 1987. Let's see, that's 1983, I guess it is. I don't remember what would have caused it to peak at that time. Let's see, was there? Oh, yeah, that's right. That was the tail end, of course, of the dual stagflation recession. And so again, that more or less matched the peak that we saw in 2008 at about 660 or 670,000. So this was reported by the BLS on March 19th. The initial claims for unemployment insurance was 281,000. And so on this graph, that would show a sharp spike up from where it was before at 200,000. But you can see where the 300,000 axis is on this. And, you know, by the standards of this graph, it looks like the kind of spike you get at the beginning of a recession. This was headline news earlier this week. They reported this on March the 19th, and so that was, I think, Thursday. That was Thursday, I believe. So that was headline news on Thursday because it was up 70,000 from the week before. On January 27, 2018, though, this number was 234,500. So spiking to 281 is not anything to be concerned about on the scale of this graph we're looking at right here, because again, we're looking at peaks closer to 600,000 than we are to 235,000. But in the week after, the week ending on March 21st, the day this was posted, this number is going to be considerably different. Now, the Wall Street Journal had this article right here on, let's see, I don't have the date of this. It's on the journal. It's there on the top somewhere. It is, yeah, down at the bottom, I guess, March 19th. All right. So that's the Thursday that data was released. So they say jobless claims rise sharply at the front end of expected coronavirus surge. But again, that was a big spike, but it's nothing compared to how high it's gone in the previous cycles, especially the last recession. So are we to be concerned about this? Well, we know that it's going to spike a lot more than that. According to the New York Times, they have made an estimate claiming that in the next jobs report that will be filed next Friday, which if you look on the right side of this graph, they're stating that already just 15 states have reported 629,899 claims. That's in the week that we have just ended here, because of course the Department of Labor statistics have a 1 week or about a week and a half lag, about a 10-day lag. So this article that appeared in the New York Times, and you can see the date there again, that's March 19th, showed, for example, the data that was released on Thursday by the Department of Labor, that's the smaller number there, saying 281,000 claims officially filed last week, and so that's the number we've been talking about. But they have been tracking at the New York Times the state-by-state reporting of the unemployment claims, because that's where the data comes from. And they're saying, by their calculation, only 15 states have reported so far, but the number of claims in that week from those 15 states comes to almost 630,000 claims, which would be a record, or very close to a record. Maybe not quite the record. It looks like it's going to more or less match what we saw in 2008. But of course, that's not likely to be the end of it. That's just the beginning of it. This is another estimate from Bespoke Investment Group based upon Google search trends, which they use a lot, and data from the same 15 states. They are estimating, because the New York Times, the previous article, did not estimate what it might be. They just said 15 states have reported this so far. So the Bespoke Investment Group on Google search trends and data from 15 states are forecasting 1.5 million filings for unemployment in the week that begins the day after I post this video. Now that you know that the high all-time was 650 or so thousand, this of course is unprecedented and potentially very dangerous. We have to ask ourselves what impact this is going to have upon the Employment Trust Fund, especially considering that this is likely to continue for a few weeks. Now, you know why this is happening. It's because governor after governor, and to some extent at the federal level, they have shut down the basic economy, saying businesses have to close. So all kinds of businesses, nearly all businesses are closed in California right now, for example. And therefore, people are laid off. Some of the larger corporations like Disneyland have offered to, or Disney for Disneyland was closed about 4 days ago, have offered to pay their full-time employees. Others haven't done that, though. So, of course, basically nearly everyone, probably 80% of the economy, is being temporarily fired in reaction to this pandemic, trying to encourage people to stay at home. So it's going to result in record claims for unemployment compensation. That's pretty clear. And that's going to cost a lot. I'm trying to evaluate what impact this will have upon the Unemployment Trust Fund, which actually funds this program. It'll exhaust the trust fund for sure, but I'm wondering how soon and how much more will they have to run as basically deficit spending to make up for the rest. At the time, it looks like they're going to expand benefits in at least the state of California and probably almost everywhere, perhaps give a little more for unemployment than they're currently offering, and at the same time extend the time period at which you can draw it down. There. Let's ask the question how much you would receive in unemployment benefits, making those assumptions that I had made in that previous slide. So here we went to that URL that was on that page, and this is the Unemployment Development Department for the state of California. And so here you can see down here you can file a claim. If you look right here, you can file a claim. Down here you've got the benefits calculator. And we're going to look at the benefits calculator to see how much you would be paid if you filed for unemployment. So going to that, we're going to start the claim on March the 15th. We'll just accept their default date. Then they say, this is a calculator, so take this first step and then go to the page, step two of three, where you have to rather tediously go through your earnings for these months from your tax records or something like that. You also have the benefit, though, of checking if your salary was the same for each month, which is normally not the case, but we're going to pretend for us that it is, so we can do this quickly. So let's go to that and type in 3460. and we see that that is entered for all of the dates they're asking for those 4 quarters. So then we go to the next step, and you can see that based upon their $10,380 estimate per quarter, which is an income somewhere in the low 40,000s per year, that you would get an unemployment benefit of about $400 per week or $1,600 per month. Extremely irritating to finally. Okay. All right. So let me summarize what we just discovered. The 3460 we're talking about, by the way, is gross income before taxes and withholding. And this is taxable income for federal taxes, but is not taxed as income in California. So when you get unemployment benefits, you get taxed on it at the federal tax level. They may suspend that for this current episode, but it isn't taxed as income in California, although it is taxed in 34 states. Now, going back to the historical material, one of the most important, as I said before, when we looked at the single month's number, is the change in the non-farm payroll, which here we're looking at that same number going from monthly 1999 to February 2020. And you can see on the right side of the graph in recent years that the economy has been very stable. It's a volatile number, and so any single month's designation doesn't mean very much, although I think the next one will. But you can see when we had the mortgage meltdown that this number was hitting minus 200, minus 400, minus 600, which is why, of course, these are monthly numbers though, which is why, of course, then we were getting very high claims for unemployment compensation. You can see in the dot-com recession around 2000, 2001, it also fell during that time, but it didn't fall nearly as far as it fell in the last recession, the 2008, 2009 recession. But this time, when these numbers are released on April the 3rd at 5:30 in the morning our time, they will probably show values below the 2009 trough, because that's a little bit of time from now. And the one that will come after on May 8th will probably break all records. So we'll keep our eye on that. Normally, like I say, this does matter a great deal. When it goes down below that blue line, then the stock market gets a little concerned about that. But you can see that it's been, since 2011 or so, very, very steady and very, very reliable. We're going to conclude this slideshow by talking about the official unemployment definition so that we'll know what we're talking about when we use that number, because that's the number that's going to soar like never before. So who is counted as unemployed? People are classified as unemployed if they do not have a job but have actively looked for work in the prior 4 weeks and are available for work. So the key part of the definition is have actively looked for work in the prior 4 weeks. So you say to yourself, well, isn't there a category of labor who has not looked for work but would still be considered unemployed, who would still take a job if they could get it? Yeah, there is. And as we disaggregate this in the next lecture, we'll take a look at that group then. So who's not in the labor force? Remember, the very first slide we looked at was the civilian labor force. So here's that list. All members of the civilian non-institutional population are eligible for inclusion in the labor force. Say non-institutional population, that means going to institutional would be going to school or being in a long-term care facility or something like that. And those 16 and over who have a job or are actively looking for one are so classified. All others, those who have no job and are not looking for a job, are counted as not in the labor force. So that's going to be kind of a gray area that we clarify in the next lecture. The official unemployment numbers that you hear all the time, the 3.5%, does not have any gray areas in it. It's people who are looking for a job and have looked for work in the past 4 weeks and would take a job if offered. And in the survey, it's not just any job that was offered, a job that's suitable for their training is kind of how that's defined. So many who do not participate in the labor force are going to school or are retired. Family responsibilities keep others out of the labor force, while still others have physical or mental disability, which prevents them from participating in labor force activities. And so this language is not mine. It's the language of the U.S. Government Department of Labor Statistics. Now, when we look at the official, we call it unemployment rate, then you can see, we've seen this graph actually before, except that I brought it up to date. We have one more, not one more, I think 3 or 4 more observations. This goes all the way up to February 2020, so it's very current. And we've seen the red lines before. Those are the troughs of business cycles in this case. So if you start looking at this from the left to the right, you can see that the troughs of the business cycle coincides with the peak of unemployment, more or less. There's sometimes a little lag and even sometimes a little lead, but mostly unemployment is lagged. So when you see in the 1971, when we see in 1975, and in 1980, we don't have quite the, that's actually 81, we don't have quite the alignment, but there's kind of a close alignment. We can see there too, though, that there was a lag that continued on into 1983. And you can also see in the later cycles in the 90s and the dot-com crash and whatever, for those, unemployment lagged the cycle by a few months. And we said that before in this class, but sometimes, for various reasons, the unemployment rate continues to rise for a while, even though the economy, once the cycle has hit its trough, as can be seen here. Now, in the last downturn, in 2010, there's actually an extra line that should not be there. The red line is to the left of the last line on the right was actually the original location. I moved it without erasing it, sorry. So that little narrow line, the one on the left, isn't supposed to be there. So the would likely have gone below that had it not been for what happened in this last couple of weeks. Well, that's enough material for now. We're going to put together the material for the next